Hi everyone, this is Martin. Thank you for watching this market review. Uh, January was quite a relief compared to what we observed last year. As you can see, whether it's world equities, there's been a stark rebound, almost what the downturn was for the whole year of 2018. Same thing for commodity prices. Just think in terms of oil prices, up nearly 20% in January alone. So a stark contrast with what was observed after a very difficult last quarter. So clearly, when you think in terms of global equities, they really got off to a flying start, recuperating some of the losses that were incurred in the last quarter. And as we speak today, the market is green all across the board, and we're probably somewhere near 9% in terms of North America in terms of market action. So we're really happy to see that. We're really happy to see that it paid off to stay invested in the last quarter. And because we couldn't really explain the amplitude of the downturn in December, we clearly see that there was a lot of pessimism in the market, and as such, the recovery in investor sentiment has paid off, and therefore there was a sharp rebound that followed that downturn in December. It was also accompanied by stronger manufacturing activity. It was the sharpest fall of that indicator in December, falling all the way down to 54.9. But there was a rebound as we learned last Friday. So it's good to know that we're with a showing of 56.6%, that the manufacturing activity is still strong in the U.S. It was also accompanied by an about turn from the Federal Reserve. Now the market is expecting a very long pause from the Fed. When you're looking at rates right now, the implied Fed funds futures, even the futures in the U.S. is they're suggesting that there's going to be a pause, followed by probably some interest rates drops or cuts coming in 2020. We're not really there right now, but there would need to be a lot more inflation in the pipeline and stronger economic data for the Fed to really go back on its course of action that we saw in 2016, 2017. But for now, markets are expecting a long pause from the Federal Reserve, which when combined to what we're seeing from other central banks outside of the U.S. and more precisely in China, with the People's Bank of China increasingly stimulative. As you can see, they've dropped the reserve requirement ratio a few times, almost 350 basis points over the last year. So that's going to be helping the Chinese economy to orchestrate a soft landing. So probably is going to help alleviate some of the uncertainties linked to Chinese growth. And with the help also of fiscal measure, there were tax cuts that were announced that will probably take hold somewhere in the first half of 2019. It should again alleviate some of the uncertainties linked to Chinese growth. So these are all positives. There's no doubt about that. But we nevertheless think that it's time to take a little bit of risk off the table. We remain in favor of risk assets altogether, but we've decided to lower our overweight equities by one notch because for one thing, there's going to be a very important date to watch, which is March 2nd, for this agreement on tariffs or the Chinese, the U.S.-Chinese trade war that's ongoing. So the talks are good right now. There's been some progression. But we're going to wait for the definite course of action that should be announced on March the 2nd. And until then, there should be, a little bit of uncertainty on both parts. And also, when you on the technical basis, when you look at the graph on chart 8, you see that we're back to our now downward sloping long-term trend. And last time that happened in 2016, of course, it was time for the market to kind of reevaluate everything. And usually when you get such a sharp V recovery like that, market tends to be a little bit washy for the next few months. So therefore, we're taking a little bit of risk off the table because of that, and that's going to give us, if there's a pullback, that's going to give us a little bit more ammunition if we want to go back into the market. But we'll wait for that to happen before we do that. We think it's also a good time to take some profits off of our American overweight. As you know, we've been overweighted U.S. equities for almost the past 5 years. It paid off well, but now we think that with the Fed pausing for the foreseeable future, it means that the greenback will probably reverse course or reverse back to its downward long downward trend. The broad index is already very topish, back to its high of 2002, and major partners is already back on a downward trend. And whenever that happens, usually it leads to stronger commodity prices. You can see there's a clear correlation between the commodity index and the U.S. dollar, which has been inverted here to show the negative correlation that they both have, one for one. So as such, if the U.S. dollar tends to depreciate, as shown by the arrow on the chart, it should lead to higher commodity prices. So again, sort of a change in leadership, going from innovation in the U.S. to a more classical end of the cycle momentum, whether it's value, whether it's energy stocks, commodity stocks, materials, industrials, and banks. This should lead the way for this should pave the way for a change in the leadership in the coming months, and that should all be favorable to emerging assets outperforming developed countries. As you can see here, the ratio of developed countries over emerging market tends to be a 1-for-1 in U.S. dollar, with the direction that the U.S. dollar itself will take over the near future. So if we're expecting a deceleration, that should all be good for emerging markets. We also try to change our asset allocation to make sure that we get a less volatile portfolio. We've observed last year that the U.S. Markets were the most volatile, especially on a relative basis. And it's probably linked to the fact that, like I said, innovation, technology stocks, growth stocks have been assuming the leadership over the past 5 years, especially those mega caps, whether it's Facebook, Google, and all the FANGs acronym. They were part of the downturn in December, and as such, if there's a change in leadership, we continue to believe that they could be the most affected. There's also been more downward revisions in the U.S. So after 2018, which was stellar in terms of earnings growth, thanks to President Trump and those tax cuts for businesses in the U.S., now we're down to 5.7%. So the lowest earnings expectation of all of the major indices that we're following. All of that are linking to a higher price earnings ratio. So for us, it's not that the U.S. market is too expensive, and we never recommend to use the P/E ratios as a timing tool. But nevertheless, when you're seeing that the world leadership is kind of changing, we see a lot more potential at these prices in the emerging markets and the S&P TSX, the Canadian market, and that's why we've decided to take some profits in the U.S. market and reallocate that in those two areas that I just talked about. And that's exactly what our leadership, our momentum relative model is suggesting right now. So after, like I said, a very good year for U.S. equities, we're seeing that there's some sort of a leadership change in the making, and we continue to believe that the Canadian market and the emerging markets should continue to do fairly well on a relative basis over the course of the next year, especially owing to the fact that the one thing that we were reluctant to invest more in the Canadian economy was, obviously there was NAFTA for part of 2018. That was an uncertainty for us, but that's behind us. And although we still need to see the Congress to sign on this deal, we think that the worst is behind us related to that. But the one thing that was for us an impediment to a good market action going forward was the oil price spread between Canadian oil prices and global prices, and we see that after Alberta cut their production, that the spread has narrowed down to the norm of $15. So for us, it's we have the green light now. We think that in this environment, banks will continue to do well, financials will do well, materials, energy, and as such, this overweight in the TSX is a good place to be invested in the near future. So we're going to watch that. We're going to monitor that very closely for you guys. Again, if you need more details on this transaction, for those of you following us on Yammer, you'll get all of the information in an announcement that was made earlier today. Trade was done yesterday, and of course, you can always get more details by reading our monthly publication that was also published a little bit earlier in the month. So if you have any questions, please feel free to send us an email or give me a call. And on this note, I'll say goodbye for now, and we'll talk again next month. Thank you for watching.